Your portfolio goes up 10,000 euros this year. You don't sell a single share. You don't touch your crypto. You don't cash out anything, and the Dutch government sends you a bill for 3,600 euros. That is not a hypothetical. That is not a conspiracy theory. That is a law the Netherlands just passed. Starting January 2028, Dutch residents will pay 36% tax on paper profits from stocks, bonds, and crypto, even if they never sell a single asset. You are taxed on money you don't have, money that exists only on screen, money that could be worth half as much next year. And this is not the only country thinking about this. In this video, I'm going to explain exactly what the Dutch law does, why it happened, and why the liquidity problem it creates is genuinely dangerous for investors, and most importantly, what your options are, because there are several, and the people who understand them now are going to be in a very different position from the people who figure it out in 2026. And if you're new to this channel, welcome. I'm Theodora from The Passport Investor. And on this channel, we cover second residency, tax optimization, and international business structuring. So, most of what I talk about is proactive, building optionality before you need it. This video is a bit different because the Netherlands just gave us a perfect case study of exactly why everything I talk about matters. When a government changes the rules this dramatically, and they can legally at any time, the only people protected are the ones who planned ahead. So let's break down exactly what happened. First, let's understand the mechanics, because the details here do matter. Starting January 1st, 2028, Dutch tax residents will pay 36% tax annually on the increase in value of financial assets like stocks, ETFs, bonds, crypto. The gain is calculated at the end of the tax year. If your portfolio is worth more than it was on January 1st, you owe 36% of that difference. There is a tax-free threshold, a small buffer before the tax kicks in, and you can carry forward losses, but only above a certain level. The baseline is clear. Paper profit equals taxable income. Now, here's where it gets interesting and revealing about the government's own thinking. Not all assets are treated equally under this law. Real estate is taxed only when you sell. Certain startup shares are taxed only when you sell. Why? Because the government acknowledged that taxing illiquid assets annually creates serious practical problems. If you own a property worth 500,000 euros and it goes up 50,000 euros in a year, you can't easily sell a corner of the kitchen to pay the tax bill. So they made exceptions, but they didn't extend that same logic to financial assets, stocks, ETFs, crypto. These are taxed annually on unrealized gains regardless. Think about what that reveals. The government understands the liquidity argument. They accepted it for real estate. They chose not to accept it for financial portfolios. That is a policy choice, not an oversight. To understand why the Netherlands ended up here, you need to know what came before. For years, the Dutch taxed investors based on assumed returns. The government essentially said, we assume your savings and investments generate a certain percentage every year. We'll tax you on that assumed number, whether it's accurate or not. In 2021, the Dutch Supreme Court ruled that unconstitutional. You cannot tax people on fictional income that doesn't reflect reality. The old system had to go, so the government needed a replacement, and they had a choice. Option 1, build a proper realized gains tax system, tax people when they actually sell, when they actually have the money. This is how almost every other European country does it. Germany does it, France does it, Austria does it. It's the standard model. The problem with option 1 is time. Building that system properly takes years. It requires tracking acquisition prices, calculating gains asset by asset, and dealing with complex scenarios. So the Dutch government chose option 2, a shortcut. Tax the annual increase in value. Simple to calculate, easy to administer, legally defensible after the Supreme Court ruling, fast to implement, and the result is a system that is genuinely simpler for the government and genuinely more punishing for investors, especially long-term holders, especially people in volatile asset classes like crypto. This wasn't designed to be fair, it was designed to be easy. Let me walk you through a scenario that makes the real problem here concrete. You bought Bitcoin 2 years ago. Let's say it's now worth significantly more than you paid. You believe in it long term. You're not planning to sell, you're holding. Under the Dutch law, every December 31st, your Bitcoin position is valued. If it went up 20,000 euro that year, you owe 7,200 in tax in January. Where does that money come from? Option 1, you sell some Bitcoin to pay the tax. You've been forced to liquidate a position you wanted to hold. And if the market drops the following year, you already paid tax on gains you no longer have. Option 2, you pay out of pocket from other income or savings. This works until it doesn't. Until the gains in a single year exceeds what you have in liquid savings. Until you're forced to sell regardless. And option 3, you don't pay, which is not an option. Now, scale is up. A serious investor with a 500,000 euro portfolio that performs well in a given year could face a tax bill of 30, 40 or 50,000 on paper profits. In a market correction the following year, those profits evaporate. The tax bill doesn't. This isn't theoretical, this is a structure of law in the law that the government chose to implement anyway, because it's administratively convenient, and this is what makes this law dangerous in a way that a straightforward capital gains tax isn't. A realized gains tax is, at worst, inconvenient. You time your sales. An unrealized gains tax forces your hand on timing regardless of market conditions. It removes your ability to hold throughout volatility. It punishes the long-term investor for being patient. In volatile markets like crypto, growth stocks, early-stage positions, this law is effectively a tax on risk. The very assets that have generated the most wealth for individual investors in the last decade are now the most exposed. Here's the broader context, because I want to be accurate about this. Almost no other European country taxes unrealized gains on financial assets. Germany taxes capital gains, but only when you sell. France taxes, but only when you sell. Austria, Belgium, Italy, standard rates, but only when you sell. The Netherlands in 2028 will be a genuine outlier, one of the only major Western European economies taxing annual unrealized gains on financial portfolios as a standard feature of the tax system. Why does this matter beyond the Netherlands? Because other governments are watching. They are all facing the same pressure. Courts challenging assumed return systems, public pressure to tax wealth more aggressively, and the eternal appeal of revenue that's easy to calculate and hard to avoid. The Dutch solution, whatever its flaws, gives other governments a template, a precedent, a legal model that has been throughout a constitutional process and survived. If you think this is a Dutch problem, you might be right today. But the logic that produced this law exists in every European government struggling to tax investment wealth more aggressively. This is the signal. The question is whether you respond to it before or after your own government acts. So, what do you actually do with this information? There are 3 categories of responses. Option 1, you optimize within the system. The law treats different assets differently. Real estate and certain startup shares are taxed only on realization. Financial assets, stocks, ETFs, crypto are taxed annually. If you're a Dutch resident planning to stay, it might make sense to shift a portion of your portfolio into asset classes that receive better treatment under this law. Real estate investment structures, for example, may be more tax efficient under the new rules than holding ETFs directly. This doesn't eliminate the problem, but it reduces exposure for people who are committed to Dutch residency. Then we have option 2, careful timing of gains and losses. The carry-forward mechanism means losses can offset future gains. If you have positions with unrealized losses, crystallizing them in the right year can reduce your taxable position. This requires active management and professional advice, but it is a legitimate tool within the system. And then we have option 3, and this is the most effective: change your tax residency. Here is the fundamental truth. If you are not a Dutch tax resident, the Dutch tax rules do not apply to you. Full stop. Several European countries offer tax regimes significantly designed for internationally mobile investors that are dramatically more favorable than what the Netherlands is implementing. Cyprus offers an extremely attractive non-dom regime. Malta has remittance-basis taxation. Italy offers a flat tax regime for new residents. And Greece has lump sum programs for qualifying investors and retirees. These are not loopholes. These are official government programs operated by EU member states designed specifically to attract internationally mobile capital. They have been running for years. They have legal infrastructure and professional advisory ecosystems around them. The question is whether you take them seriously before your home government removes the option or after. I want to be straightforward about a few things. Changing tax residency is not a weekend project. It requires genuine substance, actual time spent in the new jurisdiction, actual termination of residency in the Netherlands, and proper legal advice on exit taxes and transition rules. You need to understand those before you move. This is also not a solution for everyone. If your entire family, business, and life is in Amsterdam, uprooting that has real costs that go beyond tax. The financial math needs to work against the personal disruption. And the law doesn't take effect until 2028. You have time to plan. That is an advantage, but only if you use it. The Netherlands just gave us the clearest possible demonstration of why having your entire financial life tied to one jurisdiction is a risk. They changed the rules legally, constitutionally, with a 2-year runway, and Dutch investors who haven't planned for this are now facing a fundamentally different tax environment than the one they built their portfolios under. This is the world we are in. The people who respond to this, who build residency optionality, who understand which jurisdictions protect their portfolio and which ones expose it, are playing a different game than everyone else. If you want to understand what your specific options look like, whether it's Cyprus, Malta, Italy, Greece, or something else entirely depending on your nationality, your assets, and your lifestyle, feel free to book a strategy call. The link is below in the description. We'll map out exactly what makes sense for your situations. And if you're not ready for that yet, still subscribe, because I cover this in all of our videos: the tax changes, the program updates, the jurisdictions worth watching. This channel exists to make sure you're one of the people who finds out early, not late. And make sure to drop a comment below. Are you Dutch, or does your country have a similar system? I really want to know how widespread this concern actually is in the audience. And see you in the next video.